Good afternoon, folks. It's time for us to watch a little Jerome Powell, one of our favorite speakers ever. Let's watch that, Let's watch that thing. Let's watch that thing. You know what I'm saying? You know what I'm saying? Now, there are some things I think we need to be aware of here. And that thing, one of those things would be the fact that we did get this news and we don't have this base yet. Let's just take that into consideration for a moment here and just state that very, very clearly. We do not have a base yet. We still have time to be patient and let people do their freaking out and do whatever the things they gotta do. It's fine. This is why we're chilling. This is why we're taking a McChill pill. When's the last time you received a signal and took a trade? Here. Here. Sorry about that, Lou, but here. Where'd I take profit? Here. So we're still paying attention if this can form some kind of base in this area. Pretty nice trade at the top there. I mean, it definitely risk to reward was there according to the monthly expected move. Very, very good. Oh my God, just because I put JK, I don't know if we're gonna crash. I don't know. But we do get earnings and that can totally flip everything else, so don't think the craziness can't continue. Crash, JK. Yeah, I like to do that. I like to play with your guys' emotions sometimes. Last trade. Man, that last trade was here. What a lucky trade, man. I didn't think we'd gap. I thought we'd see it during market hours. It'd be a little bit more emotional, but hey, you just gap down to a weekly. Easy stuff. First move, usually the fake out. Facts, 5-star. Facts. Facts. But we do get some interesting earnings, right? We'll get Tesla. That'll be interesting. We'll get Microsoft. That'll be interesting. You got some weakness signals up here, just a little bit. Tesla has reversal signal, but once again, these things could just be wiped out tomorrow. So this is why I'm really saying, like, sitting on your hands ain't a bad thing. And then Meta, and Meta's way up there, man. So you look at Meta and you're going, oof, that thing is sky high. And this is kind of what, like, I wanted to talk about was, one, the risk of earnings, right? Everything's more expensive. It's very elevated. It could end up being more elevated than fade and stuff. It's just a lot of risk. But the other thing that I was talking about was the Dow. Remember we mentioned the Dow. If you're a part of Patreon, we actually mentioned the Dow. And then we mentioned the Dow this morning, mentioning how we were heading up to this move. And I thought the risk to reward for this trade was actually good. So I actually was not sitting on my hands for this trade. We have a small trade in this guy right now. Proven to be pretty good. And that was just a simple risk to reward assessment real quick. I was like, yeah, if we like come down to here, if we at least go to 442, it can be good money. That's it. But one thing I wanted to point out here was the fact that this would be considered a lower high for the Dow. So we'll pay attention if the Dow starts. Remember that the IWM and the Dow both started to drift off, and then it wasn't until about here that really the SPY and the Qs started to actually drop from those levels. So I think it would be interesting for us to keep an eye on the Dow, because I think that could be interesting if this thing's going to fall in any kind of way. Obviously, if this thing wants to, it could just turn up on me, right? It could turn up on this 30-minute and cause me to have to manage a trade, right? And I'll lose a little bit of money, but I'm not going to lose all of it because I'll be managing the risk, and then I'll pay attention if maybe something confirms outside of the weekly. But as we're up at this level, Dow showing, hey, I could potentially do that. So that's just one thing to keep on your radar. Once again, we'll pay attention if we're going to make a base for the SPY or the Qs. If not, and we don't make that base, or that base proves and then fails, what should we be doing? We should be looking at daily charts. No crash. I mean, this was pretty much expected, right? I think everyone was like arguing whether he's going to raise or cut or whatever, and then it's just like, well, what's he most likely to do based on everything we have? Pause. And here's the thing. Why is a pause very interesting at this point? Like with all the earnings and everything like that. It's because the letter of the year is confusion. Right? Or the letter of the the letter of the year is confusion. The letter of the year is C, and C, the word for the year, is confusion. And what do you think a flat rate gives people? Do you think it gives them reassurance? Do you think it gives them fear, or do you think it just makes them confused? It probably makes them pretty damn confused. Hey, daily expected move gets tagged right there. I noticed the buying right up from it as well. C is for cookie. I'd take a cookie right now, Scott. That sounds kind of good. I'm down. You making cookies, Scott? You know you got to share with the entire class, all right? You got to be sharing with the entire class if you're going to bring cookies. Whatever, Scott. I'm going to be one of those guys that gets rejected and gets mad. Whatever, Scott. I don't even want any one of your cookies. I don't want one. Making dough. Oh, that's what's up, man. I don't think you're making cookies, but you making money, my dude. Let's go. Now let's see if this bases out. Exactly. That's it. If it doesn't base out here, I don't have to risk any money. Pretty simple. I mean, I could get you guys some cookie real quick. You guys want a cookie? I'll give you, I mean, I can bring you a cookie. But I think this would be more important to watch here. I mean, these guys are going to be pretty important. Keep track of that. And remember, the key level, you know, for the day and pretty much for the week, 590 for the week, but for the day, it starts right here, 600. Are we going to lose that? Are we going to lose 600? Are we going to lose that tomorrow, maybe? Are we not going to confirm up a 30-minute again today? Does that 30-minute confirm and then unconfirm and turn back down? Does the market open up in a big gap down or a big gap up, right? We have earnings. There's a lot going on, guys. This is why sometimes it's just best to chill. I think DIA looked pretty good. That's about it, though, for me. DIA is going to be affected by it, but if you just look at the overall, like, pattern here, you're just like, wow, that thing's just been going and going. It probably needs to retrace at some point. You even have a daily that's getting to overbought almost. Like, this is testing the highs, and we're not going to see any kind of handle here or something. We're not going to see like this at all. I think you got a good shot to see something like that. But so looking for that 2 hour to pull back down to this center line. I think that'd be interesting. Haven't even lost the 5 yet. So we got to manage this bad boy pretty close. Hopefully none of those earnings affect this. Am I right? All right. We are going to have up Jerome Powell for a little bit in a moment. We will have him up live in just a moment. I wish I could make a little box for my other screen. That'd be nice. Well, the interesting thing that I think someone pointed out, I believe it was Unusual Whales. I like to click over on Twitter and read what someone brings. And Unusual Whales actually catching this little part right here that I think is actually pretty good. The Fed removed reference to inflation making progress towards their goal. They have always had in there, oh, here's the bad thing, but we still believe that inflation is heading in the right direction towards our goal, right? They've had that in there for like almost like what, a year and a half, I think. That's not in there anymore. That means they're a little bit worried, maybe, but I'm not gonna read into it super hard because people, the way that they move their money is gonna help me out a lot more. Get your clown masks on. Breaking news, rates are the same, and that shocks the market to sink. Well, they just want to, this might be a shakeout, I don't know. It could be bad, who knows? It's kind of dependent on earnings now. The weekly expected move would suggest that earnings is maybe going to be, say, bad tomorrow, good in the afternoon, right? Maybe these things bid down and bid back up. Who knows? That's why I like sitting here, you know? I like just chilling. Absolutely chilling on weeks like this. Let everyone else lose their mind. I'm chilling. Now, if you're wondering why these yields are heading up, well, we talked about the potential for a higher low here, and we did mention that TLT was showing some divergence at the high. So we'll see if this is proving to be that 2 hour divergence is crossing down, meaning this could be a daily drop for TLT. Pretty crazy. Pretty crazy. We'll see. It's not necessarily a good thing. But It's crazy because you'll get GDP tomorrow, and that's supposed to come down. So if GDP is coming in lower, technically the rates might not go up as fast. Both learning and executing. Yeah, they're kind of two separate demons there, though. Crypto's a lot different. Crypto is serious volatility. I think you got to blow up the time frames. The stock market is like either you're investing or at least this. I'm biased on this obviously because I trade in a certain way, but it's like this. I trade my way, or I would invest, and that's it. And I would just look for those moments to invest. And I like to just pick one of these companies, see a big, monthly pullback, monthly correction, weekly correction, then I invest type deal. But yeah, I think that's really it. Day trading, it seems like a loser game. Unless you can, last long enough. It's kind of like, what's your bankroll? Can you last long enough to figure out how you're going to day trade? But some people are really, really good at it. I just know it's not one of my strengths. I might take one contract. I was thinking investing is the safest thing. The safest thing is just maybe to like grow your money over time, like doing something else. That's the safest thing, is to work a job that will guarantee you a pay. Yeah, you just gotta be quick with it, right? And you gotta be sure, and then you have to have a way to get out. And that's why I just feel like there's not too many good ways to get out besides like having a stop loss somewhere, and then they can go, you can like have your stop loss, but how many times do you see like a wick just go like that, take out your stop loss, and then go like that? That's kind of the rough part, but whatever, we'll see how this plays out. What do they expect JP to say? I don't know. We'll see if he comes in hawkish or bullish, whatever the heck. I do have the stream up on my other screen. We are McChillin'. Waiting to see what happens here. I am going to refresh the page now, see if it's up. Sometimes it takes a sec, so give me 1 sec here. Then we got to get it set up. Oh boy, oh boy, oh boy. What about you guys? You guys had a good day? The guy always says the same thing. The guy is always super vague, says he likes the outlook. Last time, literally last time, he said there is no shot at a recession. Like child retirement. No, they are going to ask him about that, and he's gonna try to most likely not take a too big of a jab. He's probably going to be like, yeah, we're going to do what we see fit based on the data, right? Okay, let me get this thing up and going here. Ah, too big. Where do you guys want this thing? I always feel like it's in a awkward spot where you like can't see the MACD very well. I wonder if I can go top left. You guys want to try like top left? Try like, we can't do top left. It's impossible. Yeah, let's do something like this. Something like this, except we gotta shrink her down. If you guys want to see that beautiful face of his, you're gonna have to shrink it down a little bit. Good afternoon, Jerome.
Our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December.
Have fun in Japan,
excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance.
Nice job, Chris.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. Considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
I look forward to your answers, Mr. Powell.
Chairman Steve Leisman from CNBC.
Stop stalking
Chairman,
people.
At a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a three-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
People heard it. He requested you drop them immediately,
I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact. Thanks.
There you go.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we literally look at movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested, more positive readings. So I think policy is well positioned.
Colby from the New York Times. Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to Follow-up. We've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do. This is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
I got you, Willow.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold, waiting to see what comes down. It's a very large economy, and policy is affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy. And so we feel like we don't need to be in a hurry to make any adjustments.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
You know, as I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, you know, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see there are alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, and not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case. But you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it's the way it's calculated for PCE. You see that coming down pretty steadily now. And that's the place where most of the remaining gap is. Part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look at that, then we seem to be set up for further progress. But being seen to set up for it is one thing. Having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly? You said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all good, but if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a let's say that the unemployment that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But yeah, I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half year.
Yeah, Bitcoin seems to be rejecting the 2-hour.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business.
Continuation of the
unemployment. Now, you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So, if those 2 things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision? Sure,
I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back, thinking about it dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Yeah, Anda, but it has earnings, so you have to take all technicals with a grain of salt.
Thanks, Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. You know, we're somewhat above that, as you know, and you know we want to see serial readings that suggest
still dependent on
we're making
earnings.
further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy.
More depends if we curl over a daily chart.
The other thing I wanted to ask
now,
was how far away
this week.
You are.
I think it's less likely. I think you're looking more towards March.
You can't know with any precision, of
seven.
course. As I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models.
Oh my God, please don't
You really
ask
have
about
to
eggs.
just look out the window and see that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Okay. Cool.
Victoria Guido with Politico. So as
She's
a general
Guido.
matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper into this set of issues today.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs.
Oh, right, you may.
Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation
Kind of
and
a pretty
growth.
voice.
If we see tariffs
Sounds
at
nice.
the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed...
We do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases. And so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite
Demand
back
goes
to 2%,
down, that's how
and
that shakes
that's
out.
just different. In addition, the kind of footprint of trade has changed a lot.
They should ask
as
about Japan.
Trade is now spread around. It's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2018. We didn't really know. And, the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Man, nothing makes me feel better than the Fed saying, we just need to see how it goes.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't
know why that is. It should be normal,
dates. But it's just that's
also,
the process, and what we see is
I have to put it full blast.
Rates do appear to be abundant. As always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters
give it a few minutes.
For us
it's
is
almost
macro
done.
developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon.
Like that answer does not help you at all.
Rabinovich with the
We're watching it.
Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point.
Super
back above
stable.
7%. I'm wondering, kind of looking forward,
stable.
Do you think, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
And what are those reasons?
Thank you, Chair Powell.
The next
Jennifer
follow-up.
Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
I want to avoid commenting even indirectly on the conduct of tariffs. It's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018 there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things. Asset prices
sorry
are,
about that, Willow.
Yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective.
You did kind of just call stocks overvaluated.
And households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions.
Yeah,
with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier. One is that there's a low hiring rate, and so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure, and in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs, and really it's high inflation for the basics of life. It's not so much the inflation now; it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much lower population growth.
One more question. Some of the uncertainty around immigration policy, is, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see. There's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But I know you don't see that in the aggregate data yet. But yes, you hear it anecdotally.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today. And I'm wondering,
you guys done with this yet?
From your
like watching paint dry. I'd rather just talk about stuff.
Markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today.
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, And that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected.
I'll show you guys something. Bam. Holy crap. I'm sorry, but I was so bored. I'm like, hearing Jerome Powell talk is just like paint drying. But I think there are some interesting things said. I'm more worried about how people are moving their money afterwards. I apologize that the stream was a little choppy there. Just note that every time I pull up any stream that's Jerome Powell, their sound is so bad that I don't know if it's my system can't pick it up or what. I had that thing bumped up to 120%, and you guys probably were still struggling to hear it. And some people saying it's choppy, so I apologize for that. I did get out of a bunch of other things so that I could make it a little bit better for you. That being said, though, the main thing we care about is they're pausing. He's still talking like he's not worried at all. A lot of people are arguing, there are certain economists out there arguing like, hey, he should be cutting rates now. So that there is, they think there's more risk of recession than apparently Jerome Powell. But I don't want to leave that up to, I want to leave that up to them. That's their job to figure out. The other thing is, I saw someone type in the chat like, oh, thank God Trump isn't in charge of the Fed or can't do anything to the Fed. I just want to know what you meant by that. Like, why? Like, because if anything, you want someone looking at the Fed because they have proven time and time again to get things wrong. Like every time we have moments like this, they get it wrong. So if they get it wrong again, which we won't really know 100% until they get it wrong, until we see these things just crumble and we see them maybe react by having to cut rates pretty dramatically. But I'm just wondering what that take is. I'm not saying Trump would be good to be in control of it. I'm just wondering, like, do you want the Fed to have to answer to someone? Because they're supposed to answer to the people, technically, right? They're supposed to answer to the people. He really cares about communities and cares about this and cares about that for you people not making a bunch of money out there and struggling with inflation. But, like, does he at the end of the day? Because everything they've done is just cause evaluations of stocks to go up, and if you didn't own stocks, then you're much poorer now. Time for a new gaming PC. Yo, I'm down. Let's start the gaming PC fund. Now you watch. I'm gonna wait for them to get oversupplied, and then I'll go in and buy last year's computer or something. It should be fine. Like, I don't know why it was messing up. It never usually. Yeah, most of the time we do that, it doesn't really mess up. So it's just weird. Bond market tells you what you need to know about rates. Right now, it's kind of back and forth, though. You're testing the 5. They're kind of, suggesting. A lot of people are suggesting, and I think they're right to do so. Head and shoulders. A lot of people suggesting this for the rates as of right now, that they're going to play out to the downside. That would mean the dollar is going to possibly follow. So what we want to see here is if these things start to really confirm down. I would say 4-hour charts, but we can read into that a little bit. But for the most part, we're just paying attention to this. We're just clicking on it. We're waiting. This is the area where we can make the higher low and try to confirm that. And then we got to manage our risk on the way up, right? If we're going to make this move and attempt it, we still got to make sure nothing goes wrong. The other part is we have earnings after hours, and you still could end up doing this, just so you're aware. You still could end up doing this. This move happened pretty quickly, so I'm going to guess that was a decent size order. Somebody bringing up IWM. IWM is going to be extra sensitive to yields. Okay, these small cap companies, they're pretty damn sensitive to the yields. You do have 30-minute divergence that could whip the 2-hour up for that next trend move higher to take out these highs. But it hasn't crossed up yet, right? We never saw that confirmation. We had it, you lost it, okay? So you have to be waiting for confirmations. That's something that we've said a million times over the last few days as we went into this week. Because look at this, it's not confirming and it's turning down. This could end up all the way down here before it actually wants to go to the upside. So that's why patience is great. Still choppy. Try to refresh maybe, because if I reset the stream, I'll probably just like pretty much if I have to go through all the resetting and stuff, it's just not going to be great. I wish there was just like a reset button, like that'd be awesome. Try to refresh your page first, make sure everything's good, check the settings and stuff like that, but if it's still bad, maybe I will try to reset here. You left and came back, and it's good? See, there you go. Maybe that works. Yeah, but the main thing here is just like, you could not watch any of that and just see how people move their money. Wait till the end of the day now. Like, he's probably done talking, like now. Now is usually the time he's done talking, and then you get about 45 minutes of price action. Is this like horrible by any means? I mean, I don't think we really got anything. We got the same old ad. We're just going to react to the data. I would say this is one time they actually did react to the data. At least they changed a little bit. They started to pause, right? They think that fighting inflation is the right thing to do. I don't think that's like horrid, right? But it just made, I mean, it made sense for them to pause. If you look at the history of the Fed, you're like, okay, they're probably going to pause here. They're not going to try to get ahead of it. They never try to get ahead of anything. They just try to react to it, which means you're always behind. If you're always reacting to data, you're always behind. Now, that goes with our trades, right? Our trades are a good example, right? Because we're going to be behind, right? We want someone to make big decisions, curl up this MACD, and then we go, hey, we'll make that decision with you, but we technically will be behind in some way. It's good for us to do that. It's not necessarily good for him to do that. It's not good to be like, oh, okay, well, inflation's like this, it's not that bad. Inflation's like this, it's not that bad. Inflation's like this, okay, we need to react down here. And then you move those yields up and you're like expecting these yields at these levels to fight that inflation. It's going to take too long. You're going to see prolonged pain. I'm so sorry, Willow. Willow, no, Willow, you know how this works. If you turn it off and turn it back on and it doesn't work, then you're supposed to unplug it from the wall and plug it back in. God. No. We had that Xbox conversation. No, I'm sorry it's messing up for you. It's just I can't. I mean, we got a few minutes left and so on. So we just have a little bit of time. So I'd hate to reset on everyone. Hopefully it's not choppy. Yeah, just like an N64 cartridge. Like you just give it that. Oh, you said that because it worked? Hey, that's good. Hey, that's good. Still waiting to see if these things can cross up, right? We haven't seen a cross up for that. We're seeing it try to right here on a negative bar, though. We don't really like to see that. IWM, I'm really liking this signal. We might have to go look at Tina soon, right? But mainly you're just looking at this and you're going, hey, if I'm just patient, I see that 2 hour confirm up. I mean, we're going to give daily expected moves for Friday. So even if you go outside of the, which I don't even think this is the right weekly expected move at this moment, by the way. IWM 234.55. I don't want you to get faked out. Way up there. So if you're like, oh, okay, well, if this 2 hour crosses, where are we likely to go to? Okay, right there. An internet provider. You guys, do I need to go have a talk with her? Do I need to go have a talk with her and be like, hey, did you pay our bill? Yeah, I'm gonna have to take off, guys. I'm sorry the stream is kind of lackluster, and tonight we won't have that YouTube video out, but we will be, and I'd be really watching this. Make sure you're managing risk throughout, but still, what I wanted to point out was just like, yeah, things are messing up. I'm not gonna have that stream or that video tonight. I have to do some other things. Big earnings after hours. Tesla, Microsoft, and Meta are the three that are pretty big, so I'm just not gonna click anything. I'm not going to click anything. I do need Starlink. Do you think Elon would help me out? Drop frames detected. 25% drop frames in the last 2 minutes. That's so wild. So I'm sorry to have to do this to you guys. I really wanted this to work out. I don't know what's going on with it, but I'm glad that you showed up today. Thank you so much, and I hope you guys have a great day.